Hey buddy, in this video, you are going to discover the 3 basic criteria that I always look out for before I invest in any single stocks. I want to share with you this so that you can invest safely and profitably in the stock market. Let's go buddy. Number 1. Economic moat, also known as competitive advantage. So right now I'm going to share with you the 4 types of moat that a company can have. Number 1. Strong brand. We all know that businesses that have strong brands are able to sustain in the long run and profit in the long run. One example is Apple. Apple brand is so strong that it attracts a lot of loyal fans. For example, people that love Apple products, even before iPhone 11 and 12 is out, they are anticipating for the next phone and willing to queue up and even pay a premium for the phone. The other types of moat is low cost production. One example is Walmart. Walmart having a huge number of stores in the whole of the United States allow Walmart to lower down the cost of production and in turn lower down the selling price of almost all its products. And because of that, a lot of customers actually goes to Walmart to buy their daily necessities. And this allows Walmart to drive out a lot of small competitors and make Walmart the biggest grocery stores in the whole of the United States. The third type of moat is high switching costs. One example is Microsoft. I believe most of us here use Microsoft Word, PowerPoint and also Excel for our daily tasks. Having to change to the other software for our daily tasks definitely make us feel very uncomfortable as it is a pain to us in terms of costing and also our daily habits. And this allows customers to stick to Microsoft for many years, and this is exactly how Microsoft make more money every single year. The fourth type of moat is network effect. One example is Facebook. As our family and friends join Facebook, we will use Facebook as well. And this is how the database grows bigger and bigger every single year. And this attracts a lot of advertisement and marketers to be inside Facebook. And because of this, the value of Facebook grows tremendously year after year. So these are the 4 types of economic moat that you have to know. And you should ask yourself whether the business that you are going to invest in, does it contain any of the economic moat? If the answer is yes, you may consider it. If the answer is no, I think you better reconsider. The second criteria is profitability. We all know that the basic objective of a business is to make profits. Only when a business makes profits, then we as shareholders can make profits as well. One way is to check this thing called earnings per share. This number represents how much profits each share is making during that year. The reason why we check earnings per share instead of focusing on just the net profit is because some companies they are making money but they are diluting their shares every single year, which as a shareholder we do not want that. So the more accurate way to know whether a shareholder is making money from this company is through this number, earnings per share. Criteria number 3, free cash flow. You want to check whether the company have positive and healthy free cash flow for the last 5 years, because it is proven that only when a company have positive and healthy free cash flow, then you have enough cash to spend and invest on research and development and grow the company in the long run. A company that have tight or even negative cash flow are definitely struggling in the business right now, and this is what we want to avoid. So long story short, these are the 3 criteria that a business need to pass for us to even consider investing in it. So number 1, economic moat. The business need to have at least 1 economic moat so the business can be sustained in the long run. Number 2, profitability. We want to make sure that the business have positive earnings per share for the last 5 years. Number 3, free cash flow. We want to make sure that the business have at least 5 years of healthy, positive free cash flow to make sure that the business can grow in the long run. Of course, there are many other criteria that we need to check before even investing. For example, whether the company have debt, what is the management like, and of course, whether the stock price currently is overvalued or undervalued. However, just by knowing these 3 criteria, it will save you millions of dollars of investing in crap business. Do comment down below to share with me what are the other criteria that you look into before even investing. Thank you for watching. I hope this video benefit you. Do subscribe to this channel so that you will be notified with all our future content to help you make a better decision and profit from the stock market. See you in the next video.